Yields out to almost 10 years are at or near the federal funds rate. Federal funds rate today is 240, and that is higher than the 2-year yield, higher than the 5-year yield, and the 10-year yield, I think, is only 15 basis points over the funds rate.
What does that tell you?
Well, you know, a flattish yield curve is meant to be an augury of something not good. And, you know, suddenly the market is baking in expectations of a Fed rate cut. I think there's 50% chance of that by the end of the year. So, you know, the Fed is meant to be patient. It contends it is patient, but there seems to be a certain jumpiness about its patience. You know, the Fed has changed course in the face of a change in inflation as they measure it. And see, in December it was 1.9, and today that number is 1.8, and that is supposed to be the source, I listened to the previous panel, of the chairman's malaise or uneasiness. I mean, that's scarcely measurable.
Well, financial conditions tightened over the last few months, and global growth got
over
worse.
the past 6 weeks or 10 weeks, maybe, financial conditions have certainly loosened. It's a mystery to me what happened.
You're saying the Fed's getting too dovish?
We'll know more in 10 years whether it's too dovish, but certainly the Fed has changed course for reasons that are not altogether apparent from its own economic projections. They hardly changed.
Judy, will the president be happy with the changing course, though?
Well, I think on the basis that Chairman Powell emphasized that this economy is in a good place, and it now appears that the Fed has adopted the creed of do no harm, I think everyone should be happy with it. We've seen the great increase in productivity, and that's just the best outcome we could be seeing. I think it's 1.8 from last year, the prior 4 quarters, compared to mostly flat for years before that. What you would hate to see is a hawkish Fed that would think about raising interest rates. The scary thing to me today is the way we raise rates, which is by basically paying banks on their reserves a higher rate of return to keep those reserves idle. The last thing you want to do is talk banks out of making loans to entrepreneurs and small business and the people who create the jobs. It's the new pro-business environment, with businesses feeling they can afford to invest in capital equipment and hire workers, that is giving you that productivity gain. And it's the increase in real economic growth that is really what we should be most focused on, and we don't want to do anything to undercut that.